Okay, good afternoon, everybody. Bobby Piton here. It is an interesting day in the markets. There's a couple of companies that are having a pretty bang up day that we'll go over. And, one of these companies we talked about yesterday, this BioNTech, the German biotech company that is making a tremendous amount of money. With regards to this COVID vaccine, it's down 5% today. It hit a high of what? I think the all-time high was $464. It's now at $362. I think yesterday it was at $382 or so. 380. I think maybe it hit $387. And so it's an interesting company. Like I said, $13.82 when it went public in October of 2019, right before this pandemic hit. And then all of a sudden it doubles in February, and more than doubles. It goes to about $30 from $13.82. Then it goes to about $55 a couple months later. And then here we are at $360, almost a $90 billion market cap. And meanwhile, Gates funded the VC that funded this company through Germany. And where's the investigations is what I would ask, folks. That's what I would ask. The whole thing seems a little weird to me. I think it should be looked into about the timing of when this thing received all of its funding and how it took off. And, what the hell is really going on here? Because this company is on track to make $5 to $10 billion in profits off of a vaccine. And this company wasn't even public 2 years ago. And now it's up 27-fold from its IPO price through yesterday. So think about that for a second. 10,000 turns into 270,000. That is definitely worth looking into by regulators, as far as I'm concerned, as to what the heck they knew. So there's a company I'm going to go over called you guys have probably all been there, at one point or another. It's called Best Buy. So we're going to go through Best Buy, and we're going to look at Palo Alto Networks. So those are the two companies we're going to look at today. One's a retailer, electronics, and then the other one is a networking company. And we'll pull that up. Let me go to the screen. I'm going to share my screen here. We're going to go to the SEC filings. Okay. So here you can see Best Buy is up about $11 today. $123. Its all-time high was right around 128. It hit 123 today, so it must have hit 128 a few weeks ago or something. But you can see that this stock, if you bought it back in 1987, 86, 85, 17 cents a share, and now it's $123. So obviously you'd have had to stay in for the entire ride, which is not the easiest thing in the world to do. But let's go to the videotape on this one. So we're going to go here. We're going to go to sec.gov. You guys are always more than welcome to pull these down yourself and see them on your end. So we're just going to go BBY, Best Buy. Today's the earnings. So go to the 8K and Exhibit 99. So here we are. Let me blow this up. Okay. So you can see that their sales increased 20%. GAAP earnings are up 76%. That's what I'm saying, folks. It pays to be a multinational corporation in this environment. A lot of these companies were never shut down. A lot of their smaller American competitors that weren't publicly traded in a lot of industries. I'm not saying there's a lot of companies that are doing what Best Buy does. But they have Geek Squad, which makes money, and some of these other businesses might have been impacted while these chains stayed open. But you can see that the profits are off the charts. This is not normal to see profits jump 76% year over year. Then there is a 47-cent benefit from lower tax year over year tax rate. Look at that. So now they said same-store sales of 9 to 11%. This is almost fictitious. And I'm not saying it is fictitious. I said it almost feels fictitious because that is a really, really hard thing to do, is to pull off same store sales that are 9 to 11% higher. It's very, very hard to do, especially for a company that's been around as long as Best Buy. So you can see that the enterprise business is growing. I'm assuming that's tied to businesses. International is growing a little bit. Comparable online sales, it's interesting. I'm not sure why this dropped 28%. So then the margins expanded a full 100 basis points, folks. They're making an extra penny for every dollar of revenues. That's unbelievable. That usually doesn't happen in retail either. It's supposed to be, it tends to be pretty competitive. So something is clearly changed, and I'm curious to see what they say. Okay, comparable growth of 20%, and then they're still saying another 9 to 11. We are lapping an unusual quarter because we had curbside service. Okay, that makes sense. When we compare to the 2 years, our results are also very strong. That's what I'm saying. So even though they're coming off of a tough year, they're still showing some pretty amazing stuff. So fiscal year 22 for the year, this is the third quarter. This is FY, which is fiscal year, 51 to 52 billion, and they raised guidance from 3 to 6% to 9 to 11. That's why it's moving up as much as it is today. Enterprise. SG&A growth 9% versus 6 to 7, but if it only grows at 9 but revenues grow 9 to 11, that's a positive. Tax rate is only 20%. Don't you wish you only paying 20% as a small business in America? They repurchased more than $2.5 billion worth of stock. It's quite a bit of stock, because I think Best Buy is worth $30 billion. So they didn't buy back exactly 10%, but they brought back 6 to 7% of the shares outstanding. Okay? So let me take a look here. Let's go to international revenues. It's still small for them. Let's see if we go to their balance sheet here. Okay. So revenues, SG&A. See their gross profit margin. So this is what they're being able to charge. So maybe all these shortages of computers and equipment and electronics is allowing them to raise prices because there's a shortage of supply. That might be what's happening here, folks, because their gross margin has gone up here. That implies that they might be able to pass through some of these price increases due to shortages. So that might not be a permanent change, is my point on the margin. You can see they did buy back 10 million shares. So 10 million shares, $2.5 billion, something doesn't jive, because 10 million shares, a million times 100 is 100 million. The stock's $100 a share, but they spent $2.5 billion. So I'm not exactly sure how they bought back $1 billion worth of stock for $2.5 billion. Something doesn't make sense. Maybe it's over that $2.5 billion was over the course of a year, not in one quarter. Well, we'll see it in the cash flow statement, folks. So let's go take a look there. Okay, so balance sheet went up by $1.3 billion on the current assets. Let me see, current liabilities only went up by $300 million, so that's healthy. Long-term debt went up by $600 million, right here. And their equity went up by almost $500 million. So here we go, net earnings. Okay, so they invested in an inventory last 6 months. They spent $800 million more. Last year they drew down inventory. This year they're using up cash, and because you can see that they earned $1.3 billion. So the $800 extra million that they made, 1321 minus 590. Pretty much they took all that extra winnings, the money they made, and put it into inventories, is what it looks like. Depreciation and amortization, that's cash flow. Stock-based comp, they picked up $71 million of cash, people cashing in their stock. They've expanded. So this number right here, 323, depreciation's 430, 323 spent. So needless to say, there's they saved $100 million that they didn't spend. Okay, so for the quarter they spent 1.3 billion. Okay, so maybe that 2.5 billion was over the course of the last 12 months. 350 million in dividends, and there we have it, folks. Here we go. Here's their product mix. You can see mobile phones, 43%. Appliances went up 2%. And consumer electronics up 2, appliances up 2, computing and mobile phones down 4. So it just kind of, the mix switched. Maybe these things are higher margins, these two categories. Maybe they're making more on consumer electronics and appliances versus computers. And so let's see if they break it out. They may not show us that margin, but it would be a good question to ask, is how much more profitable is that, right? Let's take a look here. Okay, so that's that. So that's Best Buy. I have no opinion on the stock, folks. I just want to make that clear. Obviously, it's having a very strong day. It's up almost 10%. I don't have any opinion on what the company is worth, if it's a buy, if it's a sell. I'm just letting you know that they did beat estimates, and the stock is actually doing pretty well. And so let's go to the next one, which is PANW. Okay? This is called Palo Alto Networks. Okay? It's been around since 2005. It's up almost 20% today. Look at that. That thing is on fire. 20%. The market cap is $43.33 billion. All-time high today, $446.91. And the revenue, let's go take a look at the revenue. They lost money. They're doing $1 billion in the quarter of revenue. So let's see, what is everybody so excited about with regards to this company? See, its core products are firewalls and cloud-based offerings, okay? Security equipment. So keep in mind how Huawei is a company that is come under pressure last year with President Trump, and you can see that this might be a company that's benefiting from that, because the stock was $145 and now it's $445. So it's up $300 from the low last year after losing about 40% of its value during the downturn. So it hit 395, dropped to 316. And so the valuation right now is it appears to be pretty what's the word? Pretty healthy, to say the least. And I'm not saying it's a good or a bad thing. I'm just saying it's pretty expensive on the surface, because this company is doing about $5.5 billion in revenue. Deferred revenue growth is up 30%. So that's what everybody's really excited about. Deferred revenue on these companies is kind of like recurring revenue, and it's easier to model out, which is why people are probably liking this. And so this is what's taking place here. The company, if we look here, their revenue grew at 28%, $1.2 billion versus $950. They lost 61 cents a share, and they basically are saying non-GAAP income was $1.60. So they're basically saying that their margin on this business was about 13%. 160 divided by 1.2 billion is approximately 13%. And so, that's what they're claiming, right? So let's take a look at the numbers and see how is that happening. So let's go to, here we go. Okay. So they sell, in this quarter, they sold, let me expand this a little more. They sold $339 million worth of product, and then about $880 million worth of subscription and supports. Wow. Just like that, $880 million. And so subscription and support, you can see 880 minus 270. Wow, this is this is unbelievable right here. Look at this. Gross profit margin of $860 million. That is absolutely unbelievable. So this company is doing something where I guess they're monitoring networks and doing stuff that justifies them making supposedly a much higher margin. Now let me fill you in on a little things that little Wall Street likes to look at, for if you guys are not aware of this. Now, if I was looking at this company and I said, I wanted to know if I should buy out all of Palo Alto, and once again, this is, I'm wearing my shark hat right now, folks, and I'd be like, okay, well, if I were to buy it out, how much true cash can this thing pump out with no employees? If I got rid of all my employees, how much would I have to spend? Now, the question is, what do I really need once I get a subscription model in place, right? Well, if I get a lot of people signed up, I don't have to pay salespeople indefinitely, folks. So the sales and marketing function being $500 million, this is in Wall Street looks at this as an investment, because once you get everybody using your product or service, in this case this service, eventually this number falls. This 490. This is one time. Once people are on the contracts, the salespeople don't get an annuity off of this. R&D, you can say, needs to be intact. So 860 minus 325, you get 535. G&A, right? That's office, billing, and all that jazz, 105 million. So now we're up to 440 or 430. So now we're at 430 left here. And then I would think that, this number, this 500 number, you could probably chop it to no more than 10% of sales over time, is what the number I would think would be reasonable. And once again, you'd want to look at comparables in the industry. So if you said, okay, 430, they have 430, and then we said 130, so now we're at $300 million. So you got a 20-25% margin. So a 20 to 25% margin on this company would be about $300 million. That would be about $3 a share on an ongoing basis for the quarter, okay? And so they're basically saying, this was share-based compensation, right? They added it back. You see that? $239 million. So they added back this number to come up with this 161. Now, I said long-term their earnings might be closer to $300 million once they make the changes to their workforce. I'm not saying they're going to anytime soon, folks. I'm just telling you that the reason why Wall Street is cheering this, okay, they have 100 million shares outstanding. This $1.60 is what they're saying they're earning, okay? But you can see that Wall Street is driving the stock up basically, 20% today. It's literally, hold on a second here. It's up. Palo Alto Networks. I don't know why the chart isn't working. Hold on a second. Let's see here. It's up 19% today, $72. So what I would say, when you see that kind of move, it's up 20%. On the surface, they reported a loss. It looks expensive. It looks as though they're going to do $5 billion. $5 billion, if their margins are truly 20-25%. If they weren't growing at all, that would be about a $20-25 billion valuation. Right now, it's worth $43 billion. So now you have $18 billion of valuation in there. That's assuming that they're going to grow at 10 to 15% a year. And they're going to bring their cost structure in line on the sales force. And it's probably fairly priced if they do those two things. Sounds crazy, I know. But this is the way this stuff prices, and the way people make money is getting a jump on the news and figuring out what exactly is their business model. So obviously this company's business model is detection, security intrusion probably, and they figured out a way to make themselves a utility. Now, I'm not saying it's going to hold up, and I don't know if it'll continue to hold these margins if competition won't come into come online and hurt them. I'm just telling you that this move is not irrational based on the numbers that I'm seeing. It is in line with how good of a quarter this company had. But that said, I have no opinion as to whether or not I would buy or sell this stock at this point. So, with that being said, I hope you guys have a wonderful afternoon, and I will see you all later this evening if you're going to join me for day 185 of the greatest book ever written. God bless you all, and I will see you later. Have a good one.